What's up, guys? It's Larry, the mortgage guy, your mortgage insider. And today we're going to talk about loan programs, not just your typical bread and butter ones, but we're also going to talk about ones that you may not have heard of or you may not be familiar with. We call them non-QM, non as in non-qualified mortgage loan products. So pretty excited because it's a topic that a lot of people have questions about, and also I don't think that it's really there's a lot of information on there online because these non-QM products kind of come and go depending on the market. For example, uh, before 2019, there was a whole bunch of like bank statement loans and uh, you know uh, 1099 loans and all sorts of different types of exotic loans is what I call it, right? Construction loans and such. And when COVID hit, they all kind of disappeared, right? And the reason why is these non-QM lenders, they're private investors who, for the most part, they basically invest into loans that may not be uh, attractive, I guess, so to speak, or may not be qualified for your normal Fannie and Freddie loans, right? So they kind of come out of the woodworks. They develop programs, whatever. They try to adhere to the standards and such, but they have like things that are makes them kind of stand out a little bit. Like they are willing to go outside the box a little bit, right? Like they'll ignore tax returns and still qualify, right? So we're going to kind of talk about that a little bit. And I'm not going to be able to get really deep on every single loan product because there's a lot that we want to cover. I just want to introduce kind of like the idea of it, or what does it mean, and what you might have to expect in terms of qualifications, right? That way we can start a conversation later on. And obviously this video is going to segment or segue to extra video, so I might actually do a video specifically just for bank statement loans eventually, inspired by this call, right? So, quick introduction. My name is Larry Lee. I'm a certified veteran mortgage advisor and branch manager at the Larry Lee team at Van Dyke Mortgage. I'm a licensed loan officer since 2016, which surprised me because someone was talking about my wife and how long she's been in the business. I said a couple years, and she looked at me like I was crazy because she said it's been like 5 years. So obviously, I've been there for longer than her because I was the one who brought her in. So it's 6 years, I think. I think I did the math. I don't even know my age. I think I'm like 42, 43. I don't know. So you can't ask me about years, how long I've been in anything, right? Side hustle. I'm a social media marketing coach, and I run my own agency, Robust LLC. The reason why I bring that up is because I'm trying to marry the two passions, mortgages and my social media, to sort of create this sort of environment that we're in right now. I'm trying to create classes and accessibility to content that I think will help people in the home buying process, especially clients, of course, but real estate agents as well. I'm licensed in 11 states: Arizona, California, Florida, Illinois, Indiana, Louisiana, Michigan, New Hampshire, North Carolina, Tennessee, and Texas. And I'm getting kind of paranoid because I want to make sure that I don't mess up my sound here. So I'm doing a quick sound check as I'm going through these slides. But I just want to make sure that I'm going live right now. I just want to make sure that the sound is working, right? Because last time I went live, I couldn't hear my sound. My mission, I love the mortgage business. Okay, it works. All right, my mission is that I love the mortgage business, but I was fed up with the lack of education and information clients were provided during their application process. So I created a first-time home buyer coaching class for mortgage clients that provides instant access to answers to questions and simple explanations to the mortgage process and how to qualify. Basically, what you're witnessing is me doing that right now. Okay, I'm basically trying to create content so that if someone wants to look it up and find out, they don't need to talk to a loan officer or a real estate agent. They don't have to opt in on anything. I want them to be able to freely find this information, because a lot of people who are in the business are stingy with information, or they just do a bad job of sharing information. So I want to make it so that they can, no pressure, no expectation, find the data and information they need in order to make intelligent decisions, right? I also provide one-on-one coaching for those who want it. But of course, if you want one-on-one coaching, you have to engage with me. You can't ghost me. You have to actually let me know who you are, right? Plus, I also need to know some information about you so I can coach you properly, specifically to your tailored to your situation, right? Unlike other loan officers, I made it my passion to coach first-time homebuyers on the mortgage process, and that makes all the difference of how I've helped hundreds of people get on the right path to home ownership, with many of them becoming homeowners. You remind me of many of my smart, successful, and savvy clients who are now homeowners because you are taking the right step on the home purchasing process, like they did. The home buying process is very confusing to most people, but that is why I am here, to simplify the process and make sure you are 100% prepared to the home buying process and become ahead of the competition. Now, I'm starting to realize that I may not have shared my Zoom So you guys might be like, who are Zoom, might be like looking at like a blank wall, right? So let me go ahead and share real quick. I'm sorry about that. All right. Okay, you should be able to see. You should be able to see my presentation now. Sorry about that. I'm such a newbie when it comes to these things, right? Uh, all right, cool. All right. And about the again, just I want to simplify the process, making sure you're 100% prepared in the home buying process and to become ahead of the competition. I seriously mean I want you to be ahead of the competition because there's people out there who are competing against you on making offers on these homes, right? And because of that, you are actually in a situation where you just have to be prepared to fight for your house and in a sense maybe even go above and beyond to win your house. So I want to help you uh, achieve that ability. And a part of the process that I provide is I actually can do fully underwritten TBD. I can provide fully underwritten TBD pre-approvals. What that means is I can underwrite you 100% to the point where you're basically approved as much as you can without a property, right? So basically, it's like starting the process with as far as we can without having a property involved, right? So the idea is to give you a head start, to give you a leg up, right? Because people are going to come making offers where they're not, they're not quite fully underwritten, or they're not even pre-approved, and there's still a process to get through that. Whereas I'm basically saying the loan commitment is here available right now. I can make an offer, and there's no contingency on approval because they're already approved. So it's as good as cash. Okay, so that's a way to help you with the competition. Okay, against the competition, that is. My wife, and my kids, namely my sons Bruce and Hunter, because they're both on the spectrum for autism. They're nonverbal. I'm trying to develop enough resources to provide ABA therapy for them this year. So that's my goal to basically achieve that. And my other why is, of course, mortgages, but also veterans as well. In the This post is on Facebook that explains my why when it comes to veterans. Okay, my father was living in Da Nang, Vietnam during the fall of Saigon. My mother lived in Saigon. My father left by helicopter, my mother by boat. It was U.S. soldiers who helped them get into the helicopter and on that boat. They met in Hong Kong, China. If it wasn't for U.S. soldiers, my parents may not have survived, met, and had me, and wouldn't have what I have today. I might not even exist. Those U.S. soldiers are veterans now. Thank you, vets. I owe you my life. This is actually kind of highlighting the my first time homebuyer class, and the whole purpose of these weekly calls is I'm going to talk about first time homebuyer content every single week. And I do a first time homebuyer class once in a while where I actually go over these three concepts or these three ideas, right? But I kind of gloss over and kind of summarize everything. Whereas these classes that we're having right now, my goal is to do a deep dive on every piece of information. So instead of like just doing like an hour and a half of a general idea of what first time home buying is, I'll take one specific topic that I brought up inside my first time home buyer class and we get really deep into it. That way, you can get a more, uh, I guess, a deeper understanding of what each part of my classes or each part of each detail of my class is about. Okay. Disclaimer: I'm not trying to piss anyone off or make anyone feel stupid. I'm simply trying to provide transparency because most loan officers are doing a horrible job of telling you the truth. Also, any information I share is general knowledge I acquired through training and experience. Every situation is subject to case by case basis, and exceptions are always possible, especially with different lenders and financial institutions and states, especially when it comes to the non QM loans. Okay, guys, the non QM loans, the non QM space, it's like the Wild West. Okay, what I mean by that is there's all different types of investors doing all different types of things. So what I say on my call might be different for a different lender, and the cool thing is you might find something that's a little bit easier or more flexible on that end, right? And if that's the case, I definitely want you to let me know so that I can maybe see if I can work with them. Number one, and number two, I do want to be able to I guess broaden my horizons when it comes to the content I provide. So I might be like, well, I have this non-QM lender that does this, but there's also non-QM lenders out there that does this that I don't work with because I'm not worried about telling people about what's available. I want everyone to know what is possible out there, even if it doesn't include working with me and the companies that I'm associated with, right? So it doesn't matter to me. So again, the information I'm sharing might not be across the board the rule of thumb for everybody and every lender, every state, yada yada yada, right? So hopefully that's understood. Okay. Um, so the one of the top 10 questions people ask is what kind of loan programs are available. So again, you probably heard this before if you ever attended any kind of loan officer lunch and learn or whatever. They talk about like the normal conventional FHA, USD, and VA loans, right? And I don't want to put too much energy into those today because you probably again heard it before. You can Google it. It's probably everywhere. Pretty much every lender provides this, and I'm saying lender. I'm talking about banks as well. You know, like the bigger banks, they all provide the typical QM, as in qualified mortgage loan, right? So, but just to kind of go over this, since it is part of the loan process or the mortgage business, whatever, is there's conventional, which is a Fannie Freddie product. There's FHA, which is a government insured product. There's USDA, which is a rural development, which is also government related, and the VA loan, which is of course also government related, but specifically for veterans. Okay, now I'm going to go over again a few details about them. Let's see here. Okay, actually, before I do that, does anyone have questions about those particular loan products? Right. I mean, I'm going to still go over them, but I'd rather focus on a question that someone might have because I want everyone leaving here fully informed about the loan products that are available. So, does anyone have a question about any of the typical loan products? You can put it in the chat. You can put it in the in the chat, or you can unmute yourself if you want. If there's any questions here, real quick. Doesn't look like there's any questions. Okay, cool. All right, so I'll just go over them real quick. Conventional is, I mean, I guess you can call it your vanilla loan, right? It's your typical loan that everyone's heard about. You know, it's the one that um, is I wouldn't call it a standard, but the one that everyone understands for the most part. Okay, 5% down is usually what you're looking for with a conventional loan. Okay, but there is a 3% home ready or home possible option, and that requires uh, a, an income limit, right? You can't make too much income, and it's based on the average median income in your area that you're purchasing. Okay, but it's 3%. The good thing about the 3% is sometimes you actually get a better interest rate as well. I wouldn't call it a first time home buyer program. It's just a program designed for people who have lower income. Okay. But you can get a conventional for 3%, but typically it's a 5%. Okay. With FHA, it's 3.5%. Now, what is the difference between FHA and conventional? For the most part, it's the mortgage insurance, right? Uh, with FHA, you have to pay mortgage insurance no matter what. Now, there's an exception. I think if you put like 10% down in the beginning, then you can get rid of mortgage insurance after like 17 years or something crazy like that. But no one does that, right? People would actually refinance by then. But there's that exception where you do get rid of MI after like 17 years. I forgot the number. That might be wrong, but it's a really crazy amount of time. That doesn't make any sense. Like I don't understand the logic behind it, right? Whereas conventional, if you get to 20% equity, or they call it 80% LTV or loan to value, then your MI or mortgage insurance just naturally drops off. It actually drops off at 78.5%. It is designed that way. So like if you get a conventional loan, they actually make it so that after a certain amount of payments, you're going to hit that one payment where you're no longer paying mortgage insurance. It's already designed into your payment system, right? It's usually at 78.5% equity, and that's if you do nothing. Obviously, you're probably going to grow in equity or value of your home, so you can refinance or protest and say that my house does have this amount of equity, and you into a conventional, so that even if they don't have the 20% equity yet, they'll upgrade themselves to a point where it will eventually drop off. So I never really think that you're stuck with mortgage insurance. You just have to pay it up front in the beginning if you have to go in an FHA. Uh, Now, the USD and VA, those are totally different products. They're also government, related, but they offer 0% down. And I'm going to talk about the USDA first because that's the one that most people can possibly get engaged with. It's a rural development type of loan that is encouraging people to move uh, to areas that are not as developed to basically, I guess, kind of spark again population growth. So they are willing to bribe you basically with a 0% down. And there's a lot of cool nuances about it. Like if the house over appraises, then you can actually use a part of that towards closing costs, stuff like that. There's a lot of nuances with the USDA that's kind of interesting, right? VA, of course, you have to be a veteran or married to a veteran to be involved. And you married to a veteran, and you actually might be, a widowed veteran spouse, right? But yeah, if you are, then you possibly qualify for 0% down, and that's just the VA, the Department of Veteran Affairs, willing to guarantee the loan to help you purchase a home, even though it's a 0% down. Okay, now before I go over more details about these, I'm gonna kind of list the other QM loans that I plan to cover. Okay, we got jumbo loans. Jumbo loans, for the most part, is loans that do not meet the conforming loan limit. So, conforming loan limit is something that Fannie and Freddie and other entities decide, and if you meet that amount, meaning it's not above that loan limit, then you can actually buy the house using these products. But if you end up going above that, then you have to go the jumbo space, which is considered a non-qualified mortgage. Okay, and usually non-qualified basically means it doesn't qualify based on these standards, and a lot of it is the loan limit. Okay, so considered a kind of exotic loan. Okay, but it basically means you're borrowing more than the conforming loan limit. That's basically what a jumbo loan is. You might end up seeing higher rates, higher qualification requirements, etc. Bank statement loans are basically loans that, instead of using typical, they call it full doc, right? Typical income documents, meaning W-2s, pay stubs, 1099s, or tax returns. You're basically qualifying someone based on the deposits and the activity on their bank statements. And normally they need about 12 months at least, but you can probably get a better rate and a better qualification if you have 24 months worth of bank statements. Okay. This is really popular with business owners who, for whatever reason, don't have tax returns, or the tax returns don't display the amount of income they actually make. So they use the bank statements to sort of qualify themselves. Someone's asking a question. Let me check real quick. Hey, people, we're not seeing the people, only the soundboard. Hold on real quick. Sorry. Thanks for letting me know, Richard. I'm going to make sure I share it properly. Is that better? I'm really sorry about that. Yeah, again, I'm a newbie when it comes to these things, so sorry for you know not showing the right screen at the right time. Uh, okay, cool. So again, I was talking about jumbo loans earlier. Now I'm talking about bank statement loans. Bank statement loans, for the most part, uh, bank statement loans for the most part is, again, they use bank statements to qualify you instead of your typical income documents like tax returns, W-2s, pay stubs, things like that, right? And again, it's really popular with people who do not have uh, who are self-employed or own their own business and don't have like their tax returns set up. So that's one of the main reasons why this loan product exists. Um, Someone on Facebook asked, "What is a non-QM?" Non-QM is non-qualified mortgage, right? Non-qualified, basically, it does not fit these normal bread and butter loans. And the first indicator usually is uh, it's higher than the normal loan limit. That's why it would push it to a jumbo loan, right? But also non-traditional ways of qualifying people. So basically, non-qualified means it does not match the Fannie and Freddie and those other entities' standards in terms of what you can qualify with. That's basically what non-qualified mortgage means. Okay. The best way to describe it is, exotic, outside of the box kind of loans. Okay, loans that don't most lenders don't offer. Okay, you have to go like with almost like a private investor to get these. And I'm not talking about hard money. I'm talking about just private investors, people who are kind of they're willing to take risks in certain areas in order to approve loans. But of course, they either charge a higher rate or because they have such high demand, they make money that way. Okay, investor cash flow loans. This one's a little interesting, and I never really heard of this until I joined my current mortgage company, which been a couple of years. It basically is a loan for people who want to buy homes but don't have income, right? But they can prove that the home is going to generate enough income to cover the mortgage, right? So let's say you're buying a home and it's $100,000, and you think you can rent it out for $1,000, and the mortgage ends up being 850, right? Well, if you can bring in $1,000 a month on the rent, and the mortgage 850, then you effectively cover the cost of the mortgage, right? With your rent. So that's cash flow. That's why it's called an investor cash flow loan, right? The cash flow itself is what's paying for the mortgage. So you don't have to qualify based on your income. Your tax returns, your pay stubs, whatever doesn't make a difference here. It's all about the fact that the home itself is generating income, right? So that's really popular amongst like a lot of investors. I helped a lot of real estate agents with this kind of loan. So yeah, it's an interesting loan, and I'll kind of break into that a little bit more as well. 1099, same kind of concept, where instead of using tax returns or pay stubs, you're using 1099s to sort of qualify, your income, right? And again, I'll get deeper on that as well. Construction loans, I'm actually going to talk about that at the end because it's like a whole different animal. But construction loans are loans, basically you are working on purchasing a home that needs to either be built or needs to be things need to be added, like a renovation loan, right? So basically, it's not just buying a house as is. You're buying a house and you're customizing it how you want it. Again, the most typical, or the first thing you would think about, would actually be buying a home that's built from scratch. Like home builders, right? So, and we call it a OTC, or one-time close. It's financing the construction as well as the purchase of the home one time. So you don't have to do like several transactions. You do one transaction. So again, OTC, or one-time close. Someone has a question here. Let me check real quick. Geraldine asked, so does investor cash flow loan require owner to live in the property? No, Geraldine. In actuality, you can't live in the property. Okay, it's an investor cash flow, so it has to be an investment property. It has to be a property that you're generating from a tenant, right? So they do not want you to occupy. In fact, I think it's against their guidelines to occupy, and I think I'll go over that because I do have a slide referring to the investor cash flow loan. Okay. So the I-10 loans, ITIN, I forgot what that's called, or what the thing is, but it's a loan basically for people who do not have a social security number, usually people who are from out of the country, and but they're still generating income. They have a job. They might even have credit. It's a loan for people who they qualify for a mortgage, they make enough income, and they deserve a home, but they don't have all the normal documents you would need in order to buy a home. So uh, that one is probably one of my most asked about loans, because I'm in Texas, so there's a lot of people who are from out of the country living here, and there's so many different investors that offer it in different structures. So that one will be a little bit interesting. I'm only going to talk about one program that I have, but I will mention other ones as well that might be available. Okay. I got another question here. Yes. Gerald is asking, can you go over parameters for investor cash flow again, please? Yes, I will go over that. I actually have a slide dedicated to it. Okay. So if that's coming up. All right. So before I address that, because I don't want to mess up the flow real quick, but I guarantee you, Gerald, I'll make sure that you know everything about it before this call's over. Okay. Again, real quickly, conventional loans, VA, FHA, and USDA. The way I kind of look at this is conventional is like the normal loan, and the rest of them are government loans. So I'm not saying that it all applies across the board, but government loans have similar rules For example, if you're in Texas, you're in a community property state. If you are married, then your spouse is considered a part of community property. So your spouse needs to be added on the application because your liabilities are their liabilities and your assets are their assets. So basically any liabilities they have on the credit report needs to be added to the loan. That's FHA, VA, and USA in a community property state. Texas is one, California is one. There's a few others I don't remember. Okay, so that's something that makes them different. Okay, I just want to just bring that up. But what makes conventional VA similar is that gifts are acceptable, and you actually can send the gift directly to title, and it doesn't need to be sourced. That's something that conventional VA share that's similar. FHA doesn't do that, right? USDA I don't think does that either. Okay, so again, I just want you to look at the matrix real quick. And of course, I'm gonna send these slides to you guys so you guys will have access to it. But just look at the fact that you have a 620 FICO minimum. More than likely, you're not going to qualify even if you have a 620. You probably have to be closer to 640, 650. But the cutoff or the hard stop is at 620. So if you're at 619, you're not going to go conventional period. You have to go down to FHA and maybe USDA, right? Unless you're a veteran. Okay. 5% again, a minimum 3% for the home rating. I talked about that. Occupancy, there's different types: primary, secondary, and investment. That is another difference between conventional and the rest of these loan products: FHA, USA, and VA. The whole point of the government getting involved with these loans is they're trying to get people inside homes. They want people to live inside a home that they need, right? Uh, so they don't allow you to use VA, USDA, or FHA as investments. You cannot use an FHA loan, a VA loan, or a USA loan to buy a property that you're going to profit off of by sending someone else to live in there and get rent for them. That's not how they work. The government loans are designed to help people live in houses. That's all that's designed for. Whereas conventional allows investors, people who want to make money off of properties, to do so. So that's why you have a primary, secondary, and an investment property. Okay. PMI, as in mortgage insurance, is required if you have less than 20% down. That means if you have 80%, less than 80% LTV or loan to value, or yeah, if you have more than that, I'm sorry, if it's more than 80%, then you are required to have mortgage insurance. But if it's less than 80% LTV, then you are good. Like, gift funds are allowed, like I said, and seller contributions, that's a little bit more complicated. That's probably another conversation. But yes, you invest more in terms of seller contributions on the conventional than typical. These guys are more like 6%. Okay. Someone's asking a question. Let me see here. Geraldine asks, on VA, can you use back to back to sell and purchase? Yes. I think the question she's asking is, if you are using the VA loan on one property and you want to buy another property, can you use the VA loan on the new property? And the answer is yes. A lot of people don't think you can. You actually can use the VA loan twice if you can afford it, right? So yeah, you can actually. It all depends on your entitlement, which of course is found on your certificate of eligibility. For most veterans, meaning people who are retired, if you're not retired, you're active duty, then you don't have a COE, but you still have documentation to show what you are entitled to. Okay, but yes, you can go back to back. You can. We actually, what we do is we qualify you based on the fact that you're going to sell your other property, and therefore your eligibility will be reinstated. Okay. And then, of course, the condition would be for you to sell the home and then get the VA to reinstate your entitlement. Okay. So, yes, the answer is yes. You can use the VA to do back to back sell and purchase. Okay. Um, okay. Back to the qualifications. Minimum FICO is 580 with debt to income limits. Honestly, you actually can go higher in DTI on FHA than conventional. That's why the FHA is so popular. You can buy more for your dollar, right? More for your income, and you can get you can have a lower score and be okay. 3.5% versus the 5%, which is typical with conventional. Again, there's the 3% exception. And of course, occupancy must be primary. Like I said, you must be the primary occupant in the home, right? And of course, there's mortgage insurance required, which I talked about earlier. And yeah, 6% contribution. VA, that's a totally different animal, and I could probably do like 20 classes on that. In fact, I am doing a bunch of classes on that. But it's almost similar to the FHA in that they have a 580 credit score minimum, and honestly, that's something that's built by lenders. Okay, VA on itself does not have a credit score. It's lenders that have that requirement, and they kind of match it with the FHA. You see, but there's no document required. You must live in the house. There's no mortgage insurance. And yeah, I mean, there's a lot of benefits involved. And again, that's a totally different conversation, and will probably be most important or most relevant if you are a veteran or you're trying to help veterans. Okay, USDA, again, it's the same thing in terms of being a government loan. It must be primary, but there's no down payment required. Okay, but again, they're trying to encourage you to move to a rural area. Okay, um, and there's other nuances as well, but the biggest one is you must move in a rural area. Oh, and there's also an income limit. You can't make too much money in buy USDA home. Okay. All right. So let's see here. I'm trying to finish by 12. So I got 23 minutes to go over the non-QM loans. Okay. Platinum jumbo. I'm not going to go too much into the details here, but basically it's saying that, houses that are do not qualify for your qualified mortgage amount, right? And then you go up to 3 million, right? And these are just kind of requirements, in terms of foreclosure and bankruptcy seasoning. You can do owner occupied, second home, or non-owner occupied. We can do purchase or cash out. They also have 40-year fixed interest only available. And it must be full dot, means you actually have to qualify. We also have the ability to do 1 year tax returns on that. And if the loan goes above 1.5 million, then it must have another appraisal. There must be 2 appraisals. Okay, but the starting scores for our program is 660, and you can go down, but basically 5% down, right? So that's how the non-QM qualifications work. Okay, but basically it just means it's the same thing I would say as a conventional, except for the fact that you're buying more house. That's basically what it is. Okay, so they still have to do full documentation. You still have to qualify, right? But yeah, you can still put only 5% and still get away with it. Okay, all right. Bank statement loans. Now this one's a little bit more complicated, right? But they do allow up to basically down to 600 credit scores. Must have 10% down though. Okay, that's the thing that's different about this loan versus every other loan. There's no loan out there in the bread and butter world, meaning conventional FHA, VA, or USDA that requires 10%. None of them requires that. Whereas the bank statement loan does, right? Let's talk about skin in the game, right? You're qualifying based on a non-traditional way of showing income. They're going to see a higher risk. So how do they offset that? They offset that by requiring you to put 10% down. Okay. And they also more than likely will have a higher rate. Okay. How much higher? It's really hard to tell, but I always guess, or I always prepare at least 1 point above. So if the rates are at threes, look at a 4% interest rate. If the rates are in the fours, look at a 5% interest rate. If the rates are fives, look at a 6% interest rate. And it might be higher. Okay. But just be prepared for that. And if you're like, wow, that's high. Why is the interest rate so high? Well, I mean, if you want to pay your taxes and do your tax returns and do the proper income, you don't have to do a big saving loan, and therefore you enjoy the qualified mortgage rates. But otherwise, if you don't want to pay your taxes, or you don't have your tax returns correct, or you don't have, and I'm just being honest here, okay? A lot of people are using big saving loans because their tax returns are not showing them the income that they want to show, right? But they want to buy more house. Well, prove it by showing your bank statements. But of course, because there's risk, they're going to charge you a higher rate. Okay. So you can't have both. It's one or the other, right? Either you pay your taxes and qualify normally, or you don't pay your taxes, or whatever it is that you're doing, right? You're not showing them enough income, whatever, and you use your bank statements to qualify. It's one or the other. Okay. Um, so there's a lot of details here. I'm not going to go over them. Again, these will be in the slides. And if you have questions about it, just reach out to me. Okay. But for the most part, they're basically using your bank statements to qualify you. 12 months worth or 24 months, business or personal. I think it's best to have business, and it's best to have 24 months, because I do know for a fact the more bank statements you have, meaning how many you have in terms of how many months, the lower the rate's going to be. Okay. So just wanted to kind of bring that up. Okay. And there's also 1099 options available as well, which is kind of interesting. Okay. Which is probably talking about the next one about the right here. Okay. But I'm not going to go over that yet, because I'm going to go over the investor cash flow loan. So Jalen was asking about the investor cash flow loan. Okay. So again, what it is, and I'm going to read exactly what it says. Okay. Investor cash flow mortgage program allows your clients to qualify based on rental analysis to determine property cash flow. Okay. It's called a DSCR, or debt service coverage ratio. Okay. It's a measurement of a property's expected cash flow to determine ability to repay a mortgage loan. And they want the DSCR to be at ratio of 1. Okay. 1 meaning, I believe, if it's $1,000 mortgage and you have $1,000 rent, that's one. Okay. So if you at least have a DSCR of one, then you should be okay. Okay. Qualifications based on property cash flow. Okay. So hopefully that makes a lot of sense. Okay. So you do need to put up to 20% down. Okay. Now they're telling you that you don't need to have a DSCR if you have a 700 credit score, and you have to put 25% down. So literally, if you want to buy a property with no proof of how much it's going to make, but you have a 700 credit score and you have 25% down, they might accept it. Okay. But see, no personal income or employment required. Okay. And the properties can be in the LLC names, which is that's another popular feature about the investor cash flow, is that you can buy it as an LLC. Okay. And there's no limit on the total number of properties. You can do this 100 times if you want to. Of course, we would have the conversation if that's what you're trying to do. But yeah, there's no limit there. Whereas I think with a regular mortgage, you are limited to 10. Okay. So you only buy a house with a mortgage 10 times before it has to be considered a commercial loan. The next, like the 11th home would have to be a commercial loan. Okay. Whereas in this program, they're saying that you can do as many as you want. Okay. But yeah, that's the investor cash flow loan. I mean, the bottom line is you're buying a home using the rent to pay the mortgage. That's basically what the bottom line is. Okay. And these are the requirements involved. And it's really popular amongst my real estate agent buddies who, they find properties that they think is going to make good money, and they don't have their income lined up the way it should be. If as long as you qualify with a DSCR, then you can move forward, right? And it starts at 600 credit score. But of course, you have a 700 credit score with 25% down. You don't have to worry about how much money you're making. There's no DSCR requirement. Okay. Okay, 1099 income loan. I kind of look at this as sort of the same thing as your bank statement loans, meaning instead of using your typical tax returns and your typical W-2s and pay stubs and whatnot, you're just showing your 1099, and it's designed to calculate how much they think you can make, right? And they actually tell you how much you need to put down. If you have a 700 credit score, you can put 10% down. If you have a 640 credit score, you must put at least 20% down. Again, they're offsetting the risk, right? It's riskier to go with a person with this kind of qualification, so they're gonna expect more down, right? And I do have clients who, they have plenty of funds, but they don't have their traditional income documents showing the income that they think they deserve. So this is a route for that. Okay. But you must be self-employed and working for the same employer for at least 2 years. Okay. And it's for owner occupied second homes or investor. Well, they say not owner occupied, which is like an investment home. Okay. You can do purchase or cash out. And of course, there's the same limits in terms of loans up to 3 million, minimum 150,000. Anything above 1.5 million is going to need a second appraisal. Okay. And we can start at 600 credit scores on that one as well. Okay, the I-10 loan. You notice if I went in order, I skipped the construction loans because again, that's a totally different animal. Okay, and I don't want to get into that just yet. I-10 loans, again, it's it's called the individual tax identification number. So I'm glad it's on here, right? Are for borrowers who do not have social security numbers. Borrowers with I-10 cards can qualify for a mortgage as long as they meet the eligibility requirements. This loan product is a full doc non-QM mortgage offering flexibility for individuals residing in the United States. So it is full doc. We need tax returns or we need W-2s. They need to have funds, so we have to check on the funds and everything. 25%. Okay, now I know that's a lot, right? I used to have 5% ones, and I don't have those anymore. But I may have a 10% one right now. I may have a 15% one right now. Okay, but for this particular investor, and I'm kind of sticking to the same one as you can see because I want to kind of show you the availability for one investor. For this particular investor, they're expecting 25% now. But again, I do have investors I work with that can go possibly down to only 10% down. Okay. But the cool thing about this one is you can go up to 50% DTI. You can only purchase as a primary. There's no investors involved or allowed in this, right? And you can do a cash out or purchase. And again, with the 1.5 million, there must be 2 appraisals involved. Okay. But Again, this is very popular in Texas, and I actually get a lot of calls from California as well, and other states, but Texas for the most part, I get a lot of calls for this one. Okay, now the asset qualifier, I didn't really talk about this one uh, because I'm not ultra familiar with it, but it's something that again is something that I wasn't really familiar with until I joined this company. But basically, they're saying that you can use the money you have in the bank. I actually closed a loan with help. I closed a loan like this where the person had no income. The reason why he had no income, it wasn't that he didn't have money, is because he was moving and he didn't want to go find a job. He wanted to live there first and then find a job. Like he wasn't like going to rush finding a job just so he can qualify. He was like, look, I just want to move to the house, live in there, feel comfortable, and then I'll find a job whenever I can because I'm picky about the job I'm going to take. And eventually I'll have a job. But for now, I don't have income. So we're like, how much assets do you have? He had plenty of assets, and we're like, okay, we're gonna go ahead and use your assets to qualify you. And he's like, that's fine, right? So that's the reason why we went the asset qualifier route with him. Okay, 20, you can up, it's gonna be up to 25% down, right? But basically, it's a product for borrowers to qualify using their liquid assets. We do not require employment, income, or DTI to justify ability to repay. We qualify based on required assets that meet seasoning requirements. We helped retirees, undeserved self-employed, divorced with no income, and other borrowers with required seasoned assets to purchase or refinance. This easy to close loan is another solution helping borrowers with their income loan needs who cannot under agency guidelines. Okay. And it's again, I'm not really familiar with it. I'm not strong at it, is basically what I'm saying. Is I haven't done a lot of these loans, but the bottom line is that you can, if your assets are a certain amount, then you can use it to qualify as income, right? And my wife and I have talked about this because she's done loans like this. The way she explained to me, because there's different types. There's not just this one. There's also like a conventional one, meaning a QM one, right? There's all different types, but ultimately, she says if they have enough assets to cover every single mortgage payment, they qualify, right? So if they have $1,000 mortgage payment and they have 360 months on the mortgage because it's 30 years, that's what 360,000. If they have a $360,000 in the bank, then they qualify. That's basically the way she presented it to me. Okay, but for the most part, if you have a borrower who doesn't have a job, whatever, but they have plenty of funds, then this is something that we can talk about and see if we can help with them. And of course, if you are a borrower or a buyer, if that's your situation, of course, you can reach out to me and we can talk about it. I have like, I think 3 or 4 different programs that we can talk about that you might qualify for. Okay. So Geraldine asks a question. She asks, let's see here. What product would a retiree with access to funds are used to buy a home that exceeds their current month income, but the investment funds can be accessed? I think I kind of just covered that, ironically enough. But let me make sure I got the question correct. What product would a retiree with access to funds use to buy a home that exceeds their current monthly income, but the investment funds can be accessed? Okay, yeah, that's the asset qualifier. Yes, so I'm glad you asked that question. It's funny because I didn't even read your question and I covered it with this one, right? So yeah, that's the answer. Asset qualifier. Okay. And if you do have a client like that, generally I would love to talk to them. Even if I'm not in the same state as them, I can give them some intel and I can refer them to someone. Uh, so yeah, I just can't quote them a rate, right? That's something I can't do, but I can definitely give them advice or information, or at least consult them on their situation. Okay. So construction to permanent one-time close lending, and I have 10 minutes, but I want to end in 5 so that I can make time for questions and whatnot. The reason why I have a totally different slide for this is because this is a beast in itself. Okay, construction to permanent one-time close lending, basically a construction loan that we don't have to finance and close multiple times. This is a one-time close, meaning if you're an agent and you have a client and the client wants to buy the house, we qualify them. We find the property or area they want to build on. We have the qualified contractors, and we want to build the house. One time, we are going to finance the construction as well as the purchase of the home, and we all get paid at the same time. Okay, so that's what it means by one-time close. Okay, so I'm gonna click this link because again, it's an animal in itself, right? And I go with AFR. And if you haven't heard of AFR, you should definitely look into them because they're really cool. And I'm not afraid to talk about AFR because they pretty much are like one of the top construction lenders. Okay, they also do what do you call it? Double wides and single wides. Okay, so in case you're wondering, so what is the one-time close? as its name implies, one time close is a construction to permanent loan program that offers all in one financing available for manufactured, modular, and stick built homes. OTC loans allow borrowers to finance the construction of a home, lot purchase, land payoff, and permanent mortgage with just one closing. Designed to simplify the process for new home buyers, our one time close offering includes FHA, VA, USD, and conventional financing. Faster turnaround times, low construction admin fees, and ability to apply various down payment assistance programs are just a few of the way AFR has applied our expertise to a one-time close lending. Now, they're not the only investors I use, but they're the ones that are the most well known and the most I've done deals with them that reliably closed. Okay, but there's also other options as well. Okay, and I don't want to get into the details, but I want you to see that if you can qualify normally, right? FHA, VA, right? USDA, even conventional, then you could possibly qualify for the conventional loan. I'm so sorry, not the conventional, the construction loan. Okay. So it says the finance is available for these types of loan products, which is the bread and butter products, making it accessible to more eligible borrowers. Okay. So basically, they're saying you don't have to put more down just because it's a construction loan. Like just because it's a construction loan doesn't mean you have to worry about having more funds or whatever. Okay, you can actually qualify with the normal, uh, down payment. They call it LTVs and loan to value, right? So the opposite of 96.5 is obviously 3.5. Okay, so that's the way you have to kind of look at it. Okay, um, so yeah, it's a viable option for anyone who needs to build a home. Okay, and there's definitely a lot more other construction products, and there's more details, but I just want you to understand in general you can purchase a one-time close construction home with normal qualifications. Okay. Now, where there be differences, yeah, maybe there's a higher interest rate, right? Maybe there's a longer turn time, right? There might be different requirements. Obviously, we have to qualify the contractor. So if it's a contractor that's not already on their list, they have to qualify based on that. So there's lots more work involved, right? But I mean, that should be common sense. You're building a house from scratch, okay? So there's a lot more involved. But if that's the route that you want to take, we do have that available. And when I say we, I'm talking about the mortgage business in general. Of course, I have it available, but the mortgage business in general have it as well. So if you are working with a local lender, just ask them, do you work with AFR or do you have construction loans, one time close or OTC? And if they don't know what you're talking about, there's a chance they don't have it. Okay. But yeah, that's basically how construction loans work. Okay. Of course, there's other options as well. You don't have to do a one time close or OTC, but that's really the easiest and most popular way to do a home loan. Right. That's basically what builders do. Okay. Well, actually, builders don't do they don't do an OTC because they are financing the build. So that's actually technically incorrect. But the way you buy a house from a builder is like the same way this is trying to be like, where you just you just sign and then you get the home, right? So basically that's how we're trying to present that. Okay. Okay. Does anybody have any questions? You can unmute yourself or you can put in the chat, wherever you like. Sorry for the guys who came in. I forgot to put you as a panelist. I'm making you a panelist right now or allow you to talk right now. No. That would be a lie if I said that. The asset qualifier loan is by an investor who's really popular. So the name of it is actually Angel Oak. So if you talk to your lender, you're gonna ask them, do you have the asset qualifier? If they say no, they go, well, do you work with Angel Oak? If they say yes, then they do have access to it. They probably just don't know. But no, that I'm not the only company that provides it. I wish I was. I'd be really busy, but no, I'm not. That's something that an investor that is connected with a lot of different lenders and brokers. They provide that. And I'm sorry, who asked that question? I can't even tell. Well, whoever asked that question, thank you. Anybody else have a question? Anybody? Sure. if they work with Angel Oak. Yeah, Angel Oak is one of the investors. There's plenty of investors that offer it. Okay. The one that I highlighted was Angel Oak. Okay. So if you talk to your lender and your lender says we don't do asset qualifier, ask them, well, do you work with Angel Oak? If they say yes, then they actually do have asset qualifier. They just don't know about it. Basically, it's a product that someone they work with offers, and your lender just doesn't know about it. So they might be telling you no when the answer is actually yes. They just don't know. Yeah, no problem. Of course, Geraldine, right? Thank you for asking your question. I love the fact that you're really contributive. It helps make the conversation better for me, and hopefully helps other people who are on the call. So I really appreciate you asking your questions, man. Yep. Does anybody else have a question? All right. Well, I really appreciate you guys being on this call. If you have any questions, you always give me a call anytime, 832-606-2193. That's my cell number. You can call or text. You can email me at LLE, first initial L, last name Lee, at vandyke That's VANDYK mortgage. There's no E in Van Dyke. People make that mistake all the time. So again, LLE at vandyke or you can go to larrylee.com. There's some cool freebies there. And of course, links to my other videos and assets, playlists and such. If you're a real estate agent, there's a few free resources for training and such that I provide you there. And of course, if you forget everything that I just told you, you can always just Google Larry the Mortgage Guy or Larry Lee Lender or Larry Lee Dallas, and you'll probably find me. Okay. I try my best to make sure that happens. But yeah, again, I really appreciate you guys being on this call. And of course, if you have any questions, again, just I feel free to reach out to me. I would love to hear from you guys. Okay. I really appreciate everything that you guys have provided for me in terms of being an audience. So I'll see you guys later. Okay. This is Larry, the Mortgage Guy, your mortgage insider. I'm out. Really appreciate you guys being on this call, guys. I'll see you later.